In the early 2000s, America believed housing prices could only go up. Banks approved massive loans. Investors made billions. Ordinary families bought homes they couldn't truly afford. And Wall Street turned risky mortgages into a trillion-dollar machine. Then, suddenly, the entire system collapsed. Millions lost their homes. Major banks failed. The global economy entered its worst financial crisis since the Great Depression. But the real question is, how did it happen in the first place? Welcome to Passive Gecko, where we uncover the stories behind the numbers. Join me as we delve into the economic forces that shape our world. For decades, buying a home was considered one of the safest financial decisions a person could make. It was more than just a transaction. It was a cornerstone of post-war prosperity, a tangible piece of the American dream. Real estate represented stability, a way to build equity, and a foundation for generational wealth. It was seen as a reliable path to security. But in the late 1990s and early 2000s, something shifted. Federal Reserve lowered interest rates to historic lows, making borrowing incredibly cheap. This flood of easy money needed somewhere to go, and it found its home in real estate. Suddenly, home prices began rising rapidly across the United States, far outpacing wage growth. As prices climbed, a powerful sense of urgency took hold. More people rushed to buy homes, driven by a fear of being priced out of the market forever. This wasn't just about finding a place to live anymore. Investors entered the market, buying multiple properties not to rent, but to quickly resell for a profit. Speculation exploded, fueled by a popular culture that celebrated house flipping as a get-rich-quick scheme. To keep the frenzy going, banks became increasingly willing to lend money to almost anyone, abandoning traditional underwriting standards. Complex financial products like subprime mortgages were created, offering loans to borrowers with poor credit and no proof of income. The entire system was built on a single, unwavering belief that served as its central pillar. Housing prices would never fall nationwide. It was an assumption that would soon be tested with catastrophic consequences. That assumption, that home prices would only ever go up, would eventually destroy the global financial system. For generations, the process of getting a home loan was a sober, deliberate affair. Traditionally, banks were extremely careful about who they lent money to because they held that loan and its risk on their own books for decades. Borrowers needed to present a comprehensive financial picture, a stable income, a strong credit history, and verifiable proof they could comfortably repay the loan over its entire term. A significant down payment was non-negotiable, acting as a crucial buffer for both the borrower and the lender. But during the housing boom, a powerful new financial engine changed everything. The practice of securitization allowed banks to bundle thousands of individual mortgages together and sell them as complex bonds to investors around the world. Suddenly, the bank that originated the loan no longer cared about the long-term risk. Their incentive shifted entirely. The goal was no longer to make good loans, but simply to make as many loans as possible, as quickly as possible, to feed the securitization machine. In this new environment, those time-honored standards collapsed. Banks began issuing what became known as subprime mortgages on an industrial scale. These were loans given to borrowers with poor credit or unstable finances, people who would have been rejected just a few years prior. The innovation didn't stop there. Some loans required little to no documentation, earning the nickname liar loans, where borrowers could simply state their income without any verification. Others offered extremely low introductory teaser payments that made expensive homes seem deceptively affordable. The catch was that these rates would later reset, causing payments to increase dramatically, often doubling or tripling overnight. For their part, many buyers assumed that perpetually rising home prices would protect them. The logic seemed simple. If they couldn't afford the higher payments later, they believed they could simply refinance into another cheap loan or sell the house for a substantial profit. In a market that never went down, there was no risk. Everyone, from the lender to the borrower to the Wall Street investor, was acting on the same dangerous belief that the party would never end. The entire financial system, a marvel of modern capitalism, was built on a single, dangerously flawed assumption that housing prices would continue to rise forever. This wasn't just a problem for homeowners, it was the foundation of a global house of cards. The crisis didn't stop at the front door of a suburban home. Instead, Wall Street's financial engineers had devised a way to transform these individual home loans into something far more complex and far more dangerous. They took thousands of mortgages, many of them high-risk subprime loans, and bundled them together into vast, opaque investment packages called mortgage-backed securities, or MBS. These were then sliced into different risk categories, known as tranches, and sold to investors around the world, from pension funds in Ohio to municipal governments in Norway. To the buyers, these investments looked incredibly safe. After all, they were backed by the American dream of homeownership. And crucially, the major credit rating agencies, the trusted referees of the financial world, stamped these complex products with their highest ratings, AAA. This was the same rating given to ultra-safe U.S. government bonds. This seal of approval created a fire hose of demand, making the system incredibly profitable for everyone involved. The mortgage broker got a fee for originating the loan. The bank got a fee for creating the security. The ratings agency got a fee for rating it. And the traders got massive bonuses for selling it. The more loans that were created, no matter how risky, the more money everyone in the chain made. This created a powerful, self-reinforcing loop with almost no incentive to slow down or ask hard questions. The underlying risk that millions of people might not be able to pay their mortgages was ignored because the machine was generating billions of dollars in seemingly effortless profit, until the housing market finally stopped rising. Around 2006, housing prices began slowing down. Then they started falling. Suddenly, millions of homeowners owed more on their mortgages than their homes were worth. Adjustable rate mortgage payments increased. Borrowers began defaulting. Foreclosures surged across the country. And because banks around the world owned mortgage-backed securities tied to those loans, the financial system itself started collapsing. Major institutions failed. Lehman Brothers declared bankruptcy. Panic spread through global markets. Credit froze. Businesses failed. Unemployment skyrocketed. What began as a housing problem became a worldwide economic disaster. The financial crisis wasn't just about banks or stock markets. It changed millions of lives. Families lost their homes. Retirement savings disappeared. Entire neighborhoods were devastated by foreclosures. Many Americans lost trust in financial institutions completely, and the effects lasted for years. Even after markets recovered, wages stagnated. Economic inequality increased, and younger generations became far more skeptical about homeownership and debt. Since 2008, regulations on banks and mortgage lending have become much stricter. Most experts agree the financial system today is more stable than it was before the crash. But housing markets still experience bubbles. Speculation still exists. And periods of easy money can still create dangerous levels of risk. The 2008 crisis revealed something important. When too much of an economy depends on rising asset prices, even a small crack can spread everywhere. The housing crash of 2008 wasn't caused by a single mistake. It was the result of greed, speculation, bad incentives, and the belief that prices could rise forever. And history has shown again and again, when enough people believe something can never fail, that's often when the danger begins. Thanks for joining us. Remember to like and subscribe. See you next time.